Hello, everybody, and welcome. I'm Mike Khouw. Welcome to the YieldMax ETFs Down, where we discuss our funds and the markets, options trading, and when possible, we have a special guest, and we do have one today. So, just a quick rundown of what we're going to be talking about today, this week in YieldMax. First things first, YSpace, which launched shortly. You will know that this is going to be paying its first distribution next week. So we're going to announce that on the 29th. Keep your eyes open for that. We're going to be discussing a couple of the YieldMax funds in particular, largely because the underpinning stocks have had some important news. So we're going to be talking a little bit about Tesla, GUI, INYY, AMDY, and PLTY. Obviously, Tesla, Google, Intel, all of these reporting earnings. So that's some important news as well. And I think with that, I'd really like to bring in today's special guest, one of the guys that slogs it away every single day on the front lines of trading options on behalf of YieldMax, Drew Gordon. So, Drew, welcome.
Hey, Mike, thank you for having me. Guess I'll just kind of lead real quick. You can call me Drew or Andrew. I have no preference. I'm 50-50, so take your pick.
Okay. So, everybody, Andrew Gordon is one of the traders over here who keeps extremely busy with some of the more actively traded funds around here. And because of that, I thought, we don't always go in great detail to the mechanics of what we're doing. Now, some of these things I try to describe myself, but I thought for viewers who are new to this and new to the YieldMax style of funds, which sell call spreads instead of just selling covered calls against stocks, I thought I would start with this. From your perspective, what is the problem that selling call spreads is solving relative to the sort of the conventional covered call strategy?
I think primarily, a lot of the funds that we have in the YieldMax, kind of universe, they're very volatile names, and that's kind of the idea that we're trying to generate premium, by basically selling call spreads against an underlying synthetic for long stock. The issue is, with this being a short-term kind of strategy, these things can really move in a short amount of time, and they can, theoretically pop dramatically to the upside. If we were just doing a traditional kind of cover call approach here, we would be capped if that were to happen. And we would, at a certain point, once we reach that short strike, we would start to participate less and less with the upside move. And what we're trying to get around by doing spreads instead is that, hey, if stock A jumps 20% on news tonight or tomorrow morning, if it blasts through our spread, we're going to start to gain again on the upside past that spread. Whereas with a single leg, we don't have an offset to hedge against that. At a certain point, it'll just be dollar for dollar all the way up.
So, I mean, would it be a fair way to paraphrase it then to say that stocks kind of have an underlying volatility process, but they have these idiosyncratic moves, and when you sell volatility, the hazard is that you sacrifice some of those larger idiosyncratic moves just to sort of harvest premium more consistently, and this is sort of intended to mitigate that risk.
Yeah, and with these products, we're trying theoretically to catch 70% of the upside. And if you had just sold a single leg, for example, and the stock, say went nuclear, went very, very far up the ladder, you would bet you could maybe say get 50% of the upside, depending on how high it goes. The trade-off, I guess, is that if you're selling a single leg, you can get further away, but there's no cap to the upside. Whereas with spreads, because we're buying another leg and we're targeting the same premium that we would if we were to sell just one single leg, we have to get a little closer to the money. But again, if this were to really move up, we can start to gain past the long leg, which is basically hedging the single or hedging the short leg.
Yeah, I mean, you're actually beginning to touch on something. We talk about these at a sort of a 30,000-foot view a lot, but I thought because you're running, several of these strategies at large scale across, several different underlying stocks, I thought we might try to get a little bit more specific so that people can better understand what's going on here. How much of the strike selection process when you're engaged in this is set by sort of a systematic rule set versus exercising some discretion? I hear you on all the morning calls, really trying to find strike a balance essentially between the behavior of the underlying stock, where the stock is relative to the existing strikes, um, and thinking a little bit about how you choose the new ones. And I've noticed in several of the funds you're running that it's not like you have just two strikes. You ladder things a lot. Can you talk a little bit about how you select strikes and how you think about the process of sort of laddering some of these call spreads?
I guess first and foremost, I'm kind of thinking about the risk reward. And by that, I mean, how much premium am I taking in relative to the width of the spread? And this is kind of, harkening back to say a single leg. If you kind of think of this on a spectrum, if we sold just a covered call, we could get kind of the furthest away if we're, say, targeting a certain premium. And the premium is just based on kind of the IV. So that'll vary as the IV ebbs and flows. But then we could basically select, a range of different spreads here, or, theoretically a single leg if you wanted to do that. The trade-off here is, I'm going to use like AMD as an example because it's been very interesting lately. It's a $550+ stock after the Intel earnings here now. I'm selling like 15 wide on the spreads. Sometimes if the vol's up, I've got to go another increment higher to 17 and a half. But, sometimes same week, this is like 90, 100 IV, $550 stock, and I'm like 15 wide on all the spreads. And what you'll notice is as the week plays itself out, AMD might run up 50 points through the spreads, and they're still not at max loss because it's a very high IV stock. It might drop $50 below the short leg. It might still have juice on it, if it's earlier in the week, because $50, with something like AMD, it's not that big of a move, really, at least in a short amount of time. It can move like that frequently. And my thought is, well, if this were to go up 100 points, if I've only sold 15 wide, and back to kind of the risk reward on AMD, for example, I'm selling for 750 thereabouts. So if you think about that versus 15 or 17 and a half wide for the full spread, that's about 2.5 to 1, maybe, is kind of where I'm earmarking a lot of these, maybe 2.5, 3 to 1 on some of the other stocks. But that's kind of how I'm thinking about this, that if this were to, rip up 100 points, well, I've got a $15 wide spread. I sold that spread for, say, $7. So there's only $8 at risk there. And if this stock were to go up, $100, well, I'm going to be out 8 there, but I've made 92 on the 100-point move. And so that's 92 cents on the dollar. And that's, quite a bit more than what our internal guideline is for these types of funds.
Yeah, what are the internal guidelines? I mean, what sort of like the high level idea in terms of the target that people are looking to collect on these things generally? Because as you point out, some of these stocks, I mean, if we've got J.P. Morgan, not a high volatility stock.
Right.
You got Exxon. Well, it's been a higher volatility stock lately, I guess, with everything that's going on in the Middle East. And then you got stocks like some of the ones that you're trading, like AMD. When you think about what your targets are, what do how is that sort of set?
I usually start with that kind of range, 2.5, 3 to 1, thereabouts. And then based on what the IV for, JP Morgan or AMD is, that determines the premium that I need to sell for. So, for example, this week on JP Morgan, to your point, the IV locally for next week, which is what we're selling to here, it was about 22%, is what I was seeing earlier today. AMD, that's more up around 90. And the difference in stock price, factors into this as well. But for AMD, as I said, I'm selling, 750. It's really just a function of the IV and the price of the underlying stock, if you will.
Collecting 7, it strikes me. I mean, first of all, $15 wide on a call spread on a stock like AMD. I mean, your call spreads are less than 3% of the spot price of the stock, basically, is what it sounds like. And I guess when you think about it, I mean, a stock can really do over any period of time one of three things. It can go lower, can stay approximately where it is right now, or it can go higher. And if you're getting 7 out of 15 bucks for a short call spread, in two of those scenarios, you're going to win the 7. And in one of those scenarios, you're going to lose 8. So that's kind of how you're thinking about the risk reward that, if you do that enough times, chances are on a risk adjusted basis, you're probably going to come out ahead. Is that about right?
That's the idea. And, trying to kind of think about this too, since these are just weeklies, I almost kind of think of it as like a poker hand. So, we come into the week on Monday, maybe the stock makes a big move up or down, but that's just Monday. And so we might kind of sit on our hands, kind of see, is this a real move? Is it going to, revert back to the mean? But my thought is like by selling these spreads very tight, and to do that, obviously I have to sell pretty close to the money. But there's always a trade-off with option trading. And I've kind of come around to this thought that I would rather, in a worst case scenario, lag a little bit if it sits there than, cap myself dramatically to the upside, or, not have enough hedge in place if this really falls apart to the downside. And my thought is by selling these spreads risk reward, relatively tight versus the premium that I'm selling for, basically I feel comfortable sort of waiting later in the week on this because there's not a lot of notional at risk. In AMD, if I had sold a 50-point spread and, say it's 25 points through the short leg, somewhere right in between, this becomes kind of a dicey scenario as to, well, do I roll this up? That's 25 bucks of intrinsic value that I would have to eat if I'm going to roll this. Whereas the way I'm doing it, with a 15-point wide spread, there's not nearly that kind of notional risk that you risk, hey, I'm going to roll this up. I'm going to buy this intrinsic value because I think the stock is going to keep climbing. Instead, it dumps after I roll it up. Well, I've only bought, 15 wide back as opposed to 50 wide or something like that as an extreme example. And it's easier, I guess, to sort of get whole again because I didn't have to eat a massive amount of intrinsic value relative to what I'm selling for.
Sometimes when these stocks do gun significantly up and through the short call spread, you don't necessarily cover that call spread in every instance. You often talk about, and most of the people viewing haven't heard the opportunity to hear you talking about it, but you often talk about selling on top. And you just mentioned hedging, which I think some people may not appreciate that. If you're short a call spread and it runs to its maximum intrinsic value, because the stock went up so sharply, little reason to cover it. Could you talk a little bit about that and how that short call spread, although it may have softened some of the upside that you got to participate in, actually can essentially convert itself into a bit of a hedge?
Yeah, I mean, it honestly becomes sort of like a put lottery ticket or a synthetic put lottery ticket. And maybe an example of how this could play out, something like AMD, this does happen somewhat routinely because it can move so much, day to day. Again, I've got a 15 wide spread on a very high dollar stock. Let's say that this Monday or Tuesday, early in the week, rips up. And it's gone way, way, way beyond my short and long strikes on the spread that I'm looking at. That 15-point spread maybe is now, to get out of it, it would maybe be like 1450, 1475. The thought is, well, there's only a quarter, there's only 50 cents left here to kind of realize a further loss or to kind of crystallize that loss. But this doesn't expire until Friday, and this is a very high volatile stock that can move one way and the other. My thought would be in a case like this, well, the danger would be if I do nothing and this sits here for the rest of the week, it's going to start to decay against me. It's going to kind of crystallize the rest of that loss. Worse, if this were to drop down a little bit, like late in the week on Friday, let's say it pulls back to the long strike very, very late in the week, the time value on those options has decayed dramatically by this point. So if this were to happen late in the week, I wouldn't gain a lot on the drop in the underlying stock because it's still relatively to the short time frame that's left, quote unquote, far away. And so you can have cases that if you're long, all this gamma, it's blasted through all your spreads. And then late in the week, it starts to fade back. You can lose more than just the underlying stock is losing, because these spreads could continue to lose money as the stock drops if the time factor is short enough. That seems kind of weird, I know, but if you're far enough away from the strikes and the stock starts to drop, they might still be too far away relative to the short time window that's left till to expiration. They might not start to gain value as the stock drops. They might just sit there at max loss, or if they're not at max loss, even if the stock's dropping, they might lose more, if that makes sense. And so what I would do in a case like this to kind of hedge my bets, because I don't know for certain what the stock's going to do, for the rest of the week, I would go ahead and just leave that original spread that's very close to max loss, and then I would sell a new spread on top of that, given where the new price point is at a higher level. The thought being that, well, if this dumps back down, we're sitting very pretty here because I've sold extra contracts on top. That's obviously going to decay in our favor. And if it falls enough, soon enough, that original spread that was max loss might start to, gain value back again. And I've had cases on occasion, if they're far enough away, it doesn't happen that often. It's a game of probabilities. But I have had cases where something runs way up early in the week. I sell on top of it, and then it totally dumps, a day or two later. And those spreads that were at max loss, suddenly now they're not nearly at max loss, and I'm able to go back in and buy those back, for much cheaper than what they were when I sold on top of them.
Yeah, it's interesting something you just mentioned, because one thing that when people think about selling call spreads or selling put spreads for that matter, you just talked about something that usually when it comes to options overlay strategies isn't sort of a part of the conversation, which is that gamma flip, which is that convexity, which can be you're negatively convex when you're short upside call spreads or short downside put spreads. But once they run through and they run to, call it max loss. So you said, 14 and a half, 14.75 on a $15 spread. Effectively, what has happened is you went from short gamma to long, and now you effectively, if you keep that on, you're paying a quarter to 50 cents to be long a $15 put spread synthetically against the underlying. Low probability, perhaps, but the way things are whipping around in some of these names, and maybe just the macroeconomic news cycle as well, that's effectively what provides that downside hedge. And there's a chance that you sell an upside call spread when you run through that long strike. Maybe you collect another 30-40% for a shorter dated upside call spread. Do you actually, as a question for you, when you sell on top, are you usually looking at the same expiry? Are you still going out the same week, or will you sometimes you'll let it run through max loss on a call spread that expires, let's say at the end of this week? It's Tuesday. Wednesday you come in, it's towards the end of the day. Are you sometimes pushing that out to the following week, so you might actually have one short call spread for this week and a higher strike one for next?
Yeah, that's well said. It's definitely, it depends. If it's very early in the week, vast majority of the time, I'm going to stay in the same week and just sell on top of that. If we get to midweek or later in the week, I'm looking to roll more of that or just sell towards the next week. The thinking being that, as we get to say Thursday, for example, or certainly on Friday, if you're wrong, you can get burned very quick because, all of that gamma is kind of jacked up near the money for those expiring contracts when they only have a day or two to go. And so if I were to say sell something this week on top and it continues to rip up, it's going to basically crystallize a loss on the new spread very quickly because there's not very much time value left. Whereas if I were to say sell that out to next week, even if it keeps ripping up, there's still time to go on the new spread for next week. And so it's going to be more muted in how it's going to move against me, or how it's going to, have negative delta, if you will, against the underlying position because of that extra time. So it won't be quite as dramatic, I guess. Now that could, I guess, theoretically go both ways. If I were to say sell something on top late in the week this week and I'm right and it drops, it'll decay extremely fast. It won't have to move too far away from the short strike for that to be basically worthless. But to me, that's a dangerous game when you're right at the money or near the money with a day to go to expiration, because of the lack of time value there, and the gamut can be very dangerous.
Well, I mean, we know from the commentary and just talking about AMD a whole lot. This is one of the names you've been trading. What are some of the other of the YieldMax funds that you've been managing lately?
I have a decent selection of very high IV stocks, Mike. So AMD has become sort of the most interesting one, I think. And, just a few weeks back, it was pretty chill by and large. And then suddenly the world changed. Prior to that, the one that was maybe the most dramatic, if you will, was Coney, the Coinbase fund. And as luck would have it, that's a 2-for-1 special. I have the inverse coin fund as well, which is fiat. And so basically, I'm trading Coinbase on both sides of the market at the same time, which is interesting. You might think that, well, you're only having to deal with one side or the other most of the time, or only one side's kind of hitting you in the face. The other side, is easy to deal with. But I found actually that that's not necessarily how this works. You're dealing with both of them at the same time most of the time as the thing whips around. So that's definitely an interesting one. I also have PLTY, and then TSMY, which is correlates very closely to AMD, and that was another one that until recent weeks here was fairly, I would argue, relatively speaking, not bad to manage, and then it became quite interesting as well. And then I have one that is actually not a high IV stock. You touched on it earlier. That's JPO, the JP Morgan fund. That one brings its, I guess, real quick, it brings its own sort of, I guess, trickiness to it because there's no IV on it. You have to sell very, very close to the market all the time. And 90% of the time I sell 5 wide spreads on that, and it's a $300 plus stock. So just because it's a low IV stock doesn't mean that it doesn't require some kind of nuance, I guess.
Well, JP Morgan and the money center banks, I mean, other than Delta, I suppose, essentially mark the kickoff of earnings season each quarter. They've already reported. And that actually has me thinking. I'm curious, do you treat earnings weeks differently? I mean, in terms of strike placement, the width between the strikes, timing, I mean, the IV, by the way, implied volatility, because I know we've used the IV abbreviation a couple of times. So just in case there's anybody watching who doesn't know what IV is, that's implied volatility, which is a way that options traders think about how much an option costs, what its price is. But so implied volatility goes up around earnings, but so does vol itself, realized volatility. How do you treat earnings weeks differently if you do?
Let me give me 1 second. I'm going to pull up on one of my platforms here, just something that has earnings coming up, so I can kind of see the IV week to week as how that'll pop. Give me just a second here.
Actually, if you give me the name of it, I could also do a little. You can do a screen share if you like, or I could screen share over here.
I guess I was going to pull up Intel since they just had earnings today.
Oh yeah, that's a great one.
Enormous.
Mm-hmm.
So that'd be the 24th tomorrow. I'm looking at just think or swim, Mike. They've got just like a kind of an average IV for each expiration, which I like.
Mm-hmm.
And I found the IVs in here to be very, very good. The average IV, now this is kind of a range. So, it's going to factor in some of the tail strikes as well, which obviously, if you're familiar with IV, there's kind of like a smile or a smirk or a skew, if you will, for how the IV is, kind of spread across the strikes, low to high. But the average IV across the July 24th expiry, I'm seeing like 293% annualized. And if I just go then, that's baked in, and you'll see this drop tomorrow because now the binary event or the uncertainty is past. We don't have this big earnings call kind of hanging out there where no one's for sure exactly what's going to happen. And so if you were to come in and look tomorrow morning at, say, the July 31st expiry, you're going to see this number probably drop precipitously. But to give you an idea, 1 week out, and this would be, going into earnings, so this is still factoring in the earnings, it's 138. So that's a difference of like 160% just from the week of earnings to the following Friday after earnings, prior to the earnings call. And if you look at this tomorrow, you'll see these future expiries. That IV is going to drop precipitously because, again, the IV is behind us, or the event is behind us.
Yeah. So for those who are interested in trying to follow along with what it is that Drew's talking about here, options traders talk about these dynamics. So first of all, you'll commonly hear people refer to event variance. This is really what we're talking about. The way options, if you simplified options pricing somewhat, you would imagine that there's a baseline volatility process for the underlying asset. So there's a variance that's attributed to the way the stock behaves in general. That's a function of the volatility of its industry, the leverage on its balance sheet, volatility of related stocks in the market. And then there's event variance, which is the volatility associated with certain catalysts. And the most common of these is the one that happens 4 times a year for every publicly traded equity in the United States, and that's going to be earnings. There can be event variances for other types of things too, such as shareholder meetings, macroeconomic announcements or events. So one might observe, for example, that implied volatility, the price of options, gets a little bit of a bump before employment numbers or an FOMC meeting, things like this. And you'll see, so what I'm showing on my screen right now, and it doesn't look like much. All it looks like is just a straight drop and then out like this. But what this is the term structure of volatility at the money in Intel as of today. And this is what Drew was talking about. The near dated options right here are highly elevated. And the reason they're highly elevated is because you have this known catalyst. New news is going to hit the market. Stock could move sharply on that. And if you think about how the prices of options reflect this, you can imagine that if I have an option that expires in 5 days and it incorporates this event, how that's going to impact the price of the option is going to be profound relative to how that event variance is going to impact the value of an option that expires in 90 days or 180 days or a year. And what he was talking about with respect to the price of options falling after the news hits the street, sometimes some will refer to that as a volatility crush. We can actually illustrate that by going back in time. So in the case of Intel, I'm just going to take a look so I can remind myself. Their most recently reported quarter before the one that we just had now was back on April 23rd. So if I go back now and I say, okay, well, what was the volatility surface looking like on April 22nd before they reported? So it looked almost identical to the one we have right now. And then I can take a look and say, okay, well, what did it look like on the 24th after that news took place? And you get this. So you can see what happened is that after the news took place, that vol crush sucked a lot of the options premium out, particularly from these earlier months. What's interesting is that actually some of the longer dated expirations took a slight bump up. Now, part of the reason that can be a bit deceptive is because we're looking at, in this case, at the money volatility. So at the money volatility is a moving target because if the stock, right, let's just use an example. I've got stock ABC. I shouldn't use ABC because that's a real ticker now, but I have stock ABC. It trades for $100 and I'm valuing the straddle. The straddle is 50% implied volatility. And the stock has a disappointing earnings result. And let's say it falls by 5 to 10%. If I'm looking at the money implied volatility before the event, the 100 strike, and I'm looking at it after the event, the 95, the 90 strike, or something like that, it can be a little bit deceptive in that sense. So sometimes it's wiser to sort of take a look at things on a fixed strike basis, but I don't need to complicate that too much. But that's
Mike, I guess just, I don't know if you maybe covered this, but this is fairly common knowledge, but I don't know what everyone's kind of knowledge base is. If you want to just get like a rough idea of what the market is pricing in for an earnings week, a non-earnings week, and if you compare an earnings week versus a non-earnings week, you'll see big differences here. It's kind of interesting. But if Intel was, I just noticed it closed the regular session before the earnings almost right at 100.
Yes.
And so I just took a quick look at this Friday's 100 strike call and 100 strike put, and I just added the cost of selling that straddle together. It's around $12 when I just kind of eyeballed it.
Mm-hmm.
That's basically what the market, or at least the option market, was pricing in, by buyers and sellers of all these option contracts, a one standard deviation move for this week's earnings week. And we still have another day to go until expiration, obviously tomorrow, but so far it's trading in the after hours just slightly below 110. And so far it looks like the IV was a little bit north of what the realized move has been so far. Now we'll see what this does tomorrow. This could certainly rip one way or another, but just maybe a simple way to kind of get an idea of, well, at least for about a 68% probability, if you take that $12 implied move, add and subtract that to wherever the stock was, say $100 at the end of the day, they were, the option market's about 68% confident that by tomorrow's close, Intel's going to be somewhere between, say, $88 and $112.
Yeah, I mean, to if anybody's looking at the screen right now, so this is the bid in the calls right here. They were 605 bid offered at 630, puts were 595 bid at 620. So the straddle was 12 bid at 12 and a half, basically. So let's just take the mid market of that, 12 and a quarter. So effectively, your upside break even had you either bought or sold the straddle is going to be 12 and a half bucks higher or lower. So if the stock, assuming someone bought or sold the straddle and did nothing else between now and Friday expiration, that's one way to think about it. We refer sometimes to that as the expected move. Sometimes you'll hear people refer to if it's about earnings, the earnings related implied move, which is sometimes reflected as a single day move, but other times you'll just look week to week. And I think sometimes week to week is a better way to think about it, because most people aren't just trying to trade the one day event. And from a statistical point of view, the formal term for it is actually the mean absolute deviation. And the mean absolute deviation is, much like standard deviation, a statistical term that just has to do with the probabilities of moves of certain magnitude. And a couple other things that you might find this interesting, you might not, but it's a common question I've gotten it for sure is, what's the implied move for such and such a stock? And to Drew's point, the easy thing to do, find a straddle that expires immediately after that event. And in some cases now, because we've got expirations that occur multiple times a week in single stocks. Are you trading a lot of those, by the way? Do you find yourself trading a lot of intra-week
options? It's a good question. I got to be careful with that Bloomberg, the option chain, because you go in there and you're thinking, oh, if I scroll down to the next section, it's next week. But on things like AMD, it's like, whoa, wait, no, that's not Friday's expiration. I don't want to sell that one. So yeah, I've had to catch myself a couple times when I'm grabbing the strikes from the option chain in Bloomberg. Whoa, wait, what date is this again? Are they? You think will they eventually have these for every day?
It's a little bit. I mean, I guess there is sufficient demand. I mean, one of the things that I find really interesting is that, of course, when I first started trading options, there weren't weeklies. There could be an option that expired at the end of the week. Regular way expiration, if you're on expiration week, that would happen. And then they added the monthlies. And then they went to weeklies. And now in some cases, these intra-week options, and on several of the ETFs and indices, we've got dailies. For the indices, you can actually have two that expire on the same day. You can have the AMs and the PMs and SPX, which is quite interesting. But I mean, let me ask you that. I mean, that's sort of a more general question about options. I mean, do you think this is a benefit? Do you think it's a benefit to funds like these? I mean, it certainly seems like it's contributed to an uptick in volume. greater volume, I would think greater liquidity, and more sort of pricing transparency with respect to what the term structure and SKUs should be looking like. What's your thought on this?
I have a couple thoughts on it. I heard someone say, I can't take credit for this, that options are the tail wagging the dog. And I kind of liked it because I tend to think, I mean, if you look at option volumes, how they've just exploded year over year, month over month, and it just continues to do so. It's nuts. I mean, it's just wild how liquid a lot of these have become. And I feel like, at least this is kind of my thought, that at least a decent amount of the actual short-term price action, this isn't going to fundamentally, change something as a buy and hold, but in the short term, I feel like there's probably a decent amount of the price action that's actually directly reflective of the dealer's hedging activity against all this option trading.
Mm-hmm.
And it's kind of just along those lines, I was looking last night at a couple of reports, and it looks like dealers are long a fair amount of gamma to the upside, which could make this somewhat challenging to kind of push up or break out to the upside in the near term unless that kind of dynamic changes. Because the thinking is, if the dealers are long a lot of gamma above the current market, they're going to have to basically sell to hedge as that goes higher and higher. And so it'll trigger kind of a mean reverting effect if they're long gamma. Now we'll see kind of with tomorrow's expiration if that kind of flips kind of the dynamic a little bit. But I did happen to see that last night, and something to kind of think about.
Yeah, I mean, to give some sense of, today it's interesting. We can see, if you can look at my screen right now, that today's options volume in AMD was actually somewhat lower than it has been. So I'm going to just put a box around the 20-day average. That's over here. So 415,000 contracts a day on average, 239-ish thousand calls versus 176,500 puts is the 20-day average. Anyway, 343,842 options contracts traded today. But remember, everybody, that an options contract represents, typically, there are exceptions due to things like corporate actions and stuff like that, but generally, for most equity, ETF, and index options, the multiplier is 100. And so if you multiply 343,842 contracts by 100, you get 34,384,200 shares of options traded today, which is greater. This little circle up here, maybe I'll make it a different color so it's a little easier to see. So, oops, except I can't cover it up. That's not going to help anybody. Right up here in the upper left-hand corner, I realize there's a lot of numbers on the screen, but VOL, is not referring to volatility in this case, something we talk about all the time. That's just the volume for AMD. So in terms of shares traded 26.8 million, but it traded options on 34.38 million. And in some of these more volatile stocks, this is not an uncommon situation, that you will see more options on shares trade than shares trade. And to Drew's point, we know that some of the shares that are trade as a byproduct of the options flow. So if the average delta of an option that trades is, I don't know, call it 20 or 25, or even 30, call it like 1/3. That would mean that 10 million of the 26.8 million shares that traded today could, in theory, have been a direct result of hedging activity by a market maker, a dealer who was buying or selling the underlying securities. Now, not just, I know that there's a little bit of a conspiracy about that. I've gotten a lot more of this. So for those who don't know, my background was first as a market maker and then stat vol arb. So that's where I cut my teeth in the options business. But lately, something we didn't used to hear then, but we hear a lot more now, people talk about the gamma that you were just talking about, Drew, and how it could influence the underlying stock behavior. Do you see much of that? When you see a lot of open interest on a strike, do you observe that it has a tendency to either gravitate towards that strike if the dealer community is long it, or that it has like an anti-magnetic effect if they're short it? What's been your exposure?
I've noticed like on Palantir, there's like 25,000 combos. Um, and I've noticed sometimes if just the way the week plays out, where I'm selling everything sort of same or very, very close strikes, it tends to act like a magnet. Like the price tends to kind of keep finding my, large open interest block. And I have noticed that, yes, that I think the way I kind of always thought about this, if there's a lot of volume on a given strike or a lot of open interest at a certain level, there's liquidity there, basically, is how I would think about this in a very simple sense. And generally, the price finds liquidity, if that makes sense. So, if a whole bunch of people are trading this strike for whatever reason, I think there's, relatively speaking, a decent chance that the price might end up finding that strike just because, for whatever reason, market participants think that's a level of interest. And by their liquidity, their actions there, it'll basically, get other people to sort of see, well, why is all the action at this price level theoretically? So yeah, I do think it has a draw.
I think, I feel like it can also be sort of a compounding effect. So, you will often see a lot of open interest around whole number strikes or nickel strikes, right? So you have a $100 stock and people buy the 105s, the 110s, maybe a little bit more often than they might say buy the 108s or 106s. That could be fairly arbitrary, but it seems like there's a tendency for people to gravitate towards whole numbers. There
Yeah.
are technical levels which can be important to people. They see the 200 days at some level and they're thinking maybe it breaks through, so perhaps I'll buy that strike in the hopes that it does break through and breaks out, or maybe I'll sell that strike because I think there's some upside resistance. So I think there is a natural attraction that takes place for a host of reasons at various price levels that encourages more volume on some strikes than others. And then, of course, there's the mechanical effect that comes along with this as well, which is that, of course, if you're a dealer, gamma is maximized when the stock is at the strike. A far, far out of the money option doesn't have a lot of gamma. An option that expires a long time in the future, a 1 year option, doesn't have a lot of gamma. But a short dated option that is at the money has a lot of gamma. And if I'm a dealer and I'm long that strike, that means I'm a big buyer of the stock below the strike. It means I'm a big seller of the stock above it. And that creates sort of a compressing effect. We call that pinning on expiration day. We call that a pin. And it's actually quite annoying if you're a market maker, especially if you're net long a strike, but you are, say, long the calls and short the puts. So now you actually have to figure out whether once a stock pins, you need to exercise your long calls or do a contrary exercise notice, whether you're going to get a sign on the puts. Typically means you have to stick around until well after the close and see where the stock where the stock goes after the close on expiration day. So I never really did like that very much when I had a lot of open interest on strikes on expiration Fridays, and I basically had to sit around and then figure out whether I was going to do anything about it.
It's to that point, that's always a concern in the back of my mind. And maybe you could talk on this a little bit as a market maker, but I'm always worried. And there's times I'm not trying to be conspiratorial, but I feel like the dealer's almost targeting my long strike late in the week. And that's dangerous, because as we kind of touched on earlier in the show, if it runs way up and I don't sell on top and then it fades back to that long leg very late in the week, your performance, you're going to get hung there a little bit. You're going to have to buy the spread back for a good deal of the max because there's very little time left on the long leg to benefit you at this point. But that's always kind of the danger, late in the week that, hey, it looks pretty right now. The stock's ripped way up, but if this thing drops 20 points, before the end of the day and I don't do anything, it's not going to look as good. But I have noticed that, Mike.
Yeah, so this was not something I heard earlier in my career. So terms like max pain, for example, gamma exposure, these things, I think,
Are you?
I see a lot
Sorry
of
to
people
cut you off.
making.
Are you able to pull that max pain up? That shows that in
Yeah.
Bloomberg.
Yeah, you can. Oops. Yeah, you can get that off of here. And where's that? There's a little button over here. Where is that button? You can see how often I happen to look at it myself. kind of remembered it being right up here on the right. Where is that?
Is it under OPX?
Just gonna see what. Oh no, let's see. I used to have it right under Oman. There's two things
OVDV.
I don't know if that's the volatility analysis bit. Let's see if they show it here. Maybe. No. I seem to remember.
There's a graphical like.
Yeah, no, it's a feature, and I remember the button right there, but right over here. But you know how Bloomberg is. Sometimes they tease a feature, and then you have it for a while, and then you go to look for it. In OSA, for example, all of the break-even charts. Let's see here.
Go to function OPX.
There we
are. Click single expiry in the top left corner area under the PLTR. Yep.
Here we are.
And then there's a max pain one over to the right. You can track gamma. It's like a naive gamma or gex bot, basically, if you've ever heard of that. But the max pain, I'll let you kind of fill it in. But it's basically where most people would.
So the max
buyers
pain,
would lose, if you will.
As a concept, this always interested me a little bit when I first heard people talking about this, because to your point, it does have like an element of conspiracy theorist baked in, which didn't necessarily ring true to me, I have to say, as a dealer myself. The idea that the people in the dealer community were really focused on inflicting the maximum possible loss on the people who are net long options if they were short. A couple of reasons why this struck me as kind of fanciful. The first is that when I was making markets, I had positions in a lot of underlying stocks. Typically 20 to 30, but in some cases, I can still remember there was one point when I had 144 different underlying positions. So I had options on 144 different stocks plus index hedges against it. I wasn't really thinking about it that way. The other is that, if you, this is something I think that a lot of people don't realize, which is that options are not zero sum all the time. They don't necessarily have a linear relationship between the buyer and seller the way perhaps an equity might. So let me give a really simple example. You have $100 of $100 stock, so $10,000 worth of stock, and you decide you want to buy that stock for me. So you're now long 10,000 and I'm not, or maybe we both had no position, so you're long $10,000 worth and I'm short 10. Now, if that's the only position that either of us have, for every 1% that the stock moves in one direction or the other, one of us is going to make $100 and the other is going to lose 100. But in the options world, that's not really how it works, because, as a dealer, somebody comes in and they would buy 1,000 calls from me and they were 30 delta calls. I would be short those calls and I would have to buy $30,000 worth of stock, 30,000 shares worth of stock to hedge it. So remember, 1,000 calls, it's 100,000 shares worth, 30 delta. So 30 times 1,000 gets you to 30,000 shares. There is a world where the stock runs to that short strike. I'm acquiring it because the delta is going up as we go. And if it lands on that strike, then I am indeed going to make the most amount of money that I possibly could as a dealer in this simple example, because the calls expire worthless and I made money on my long hedge. That's a great deal. But the fact is that if it runs through that strike, I could still potentially, depending on what my position is, I'm still making money. If it rips through, maybe not. One of the things I often like to say about options is that if you are short options, you want it to go to your short strike. And if you're long options, you want it to blow through your long strike to basically for profits. But the truth is that I can sell calls, buy stock, hedge, and I can make money even if it runs through that short strike. And the person who bought the calls can similarly make money. So it is not necessarily zero sum. And it's it's also an interesting dynamic just generally when people trade vol. If I bought a straddle, it can go back and forth between that straddle. It may you were talking about Intel, so the Intel straddle was $12.50, and if I had that thing from the middle of last week until the end of this one, it may never go above $113. It may never go below $87. But if I bought that straddle and I was hedging my gamma all along, and it was whipping back and forth, up 5, down 7, up 8, down 10, never violating the break evens, but just going back and forth, it's entirely possible that hedging my gamma, I could make money. So I could make money, and the person who sold me the straddle could make money, and then the options just expire worthless. It's not zero sum for that reason. It's kind of an interesting thing about options that I think people don't realize is that you can have more than one winner. Of course, you can also have more than one loser. So I hope that's not how it turns out. What are your thoughts? And let me ask you this: it's a more general sort of question about the market. I mean, you're a very active market participant, huge experience in this. You've seen a lot of different market regimes. Every single market regime is a little bit different, and sometimes they have echoes of other market regimes. I guess my question is, what do you see in the market that you feel good about that reminds you of things that you've previously seen, and what are the things that you feel a little bit more uneasy about just in general as a market participant, given how things have been behaving, let's say, over the last 90 days or so?
I think on the positive side first, I always kind of think the trend is your friend, and obviously things have been going up by and large. I was looking at an ES chart here earlier, and it definitely looks like it started to move into more of a sideways sort of slope, if you will. I mean, this thing ripped up pretty aggressively there for a few weeks, but if you kind of step back and look at it now, it's kind of trading in a range. It hasn't continued the same upward slope. The hope would be that this does end up breaking out to the upside. I had seen last night most of the earnings calls so far, and I know we're just kind of getting into this earnings season. Most of them have been beats, so that's certainly a positive. Another couple areas that I was looking at the other day that would certainly, I think, add credence that the bull market is legit and will continue. I see financials acting very strong. We just had a round of bank earnings. Banks have set new all-time highs here recently.
They crushed it.
You'll see similar with industrials. Small caps have performed pretty well. And in a vacuum, you kind of say to yourself, well, generally, if banks are setting all-time highs, the economy's probably not about to fall off a cliff, right? But, certainly these are very interesting times here. And on the other side of the coin, there is sort of a wall of worry here, I guess. And I'm curious if we continue to keep trying to climb that. But next week is Fed meeting for July. I noticed the probabilities have started to price in a little bit higher chance that they might hike. And you saw the oil move today. It ripped back up here as we're apparently back in the war. So I think, the oil move, Warsh is a new Fed head here, talking at least to this point that he's maybe going to have a little different approach and maybe try to be more of a sound money head. Now, we'll see if he continues to talk that talk when, things get dicey here. Usually they cave, but he does seem like he's, at least so far, going to have maybe a different approach to this. So I think that's certainly something that's breeding uncertainty at the very least. We're getting here in a time of the year here in late July where if you look at kind of a seasonality chart of the VIX, for example, generally this is the bottom right around now, and it starts to then go up through October, basically. And so seasonality is starting to become a little interesting, and along those lines as well, we're maybe unfortunately getting closer and closer to the election here. And I was looking at odds on Polymarket last night. they're pricing in about an 85% chance that the Democrats are going to take the House, which I do wonder, does the market get a little upset there that Trump doesn't have, unchecked power, I guess, because say what you want about Trump, but I think seems pretty common knowledge that he does watch the stock market very closely, for better or worse, and he sort of judges that or looks at that as a judge of how he's doing. And if his hands are tied to some degree because we have a split government, I could see how the market could get a little dicey along that line.
I wonder on that point. I mean, if both houses swung the other way, and I'm not saying that that's the likely outcome, because it does look, to your point, like the House probably swings to the Dems, and the Senate probably stays in the hands of the Republicans. I would think that investors might not be enamored of the idea if both the House and Senate swung, because it increases, you have a lot of risk of political strife, because it opens up, we go back to things like, impeachment hearings and stuff like that. And that's never a good thing in terms of, first of all, not a lot of productivity is going to be enjoyed in Washington, I think, if that were to happen. And, kind of just drags the whole country through another bit of a morass. Obviously, we have a bit of a morass going on in the Middle East. To your point, August and September, people often think of October as being the choppiest month for equities in the United States. But actually, September? It is September. That is right. And so you will typically see a bit of an uptick in volatility post Labor Day. So we might expect that. As for the Fed, I've said this before. I will say it again, and I'm just gonna close this up just as a reminder. So here, I'm going to highlight in blue. Hopefully everybody can see that. So highlighted in blue, it should get a little brighter. That is the Fed funds target rate. So off, on. That is the Fed funds target rate. And this other choppier line that I'm showing is the US 2-year. And I'm always amused a little bit when people think about what will the Fed do next? There's all these wizards behind the curtain having these secret meetings, and then they have their public statements. What are they going to do? Well, for the last quarter century, they just followed the 2-year. The 2-year began to drop before the Fed funds target rate dropped here. It began to rise before the Fed funds target rate did there. It began to fall. Again, you can see pretty clearly that if you simply followed the 2-year, you didn't need to wait for Fed speak, for FOMC minutes, for Janet Yellen or anybody else to get behind the podium to tell you what they were going or not going to do. You just followed the 2-year. Now, this wasn't always the case. During Volcker's time, there were huge divergences. But the reason I mention that is because if I shorten this little chart up for a little bit, and we look at it over just the course of the last 5 years, this is what the 2-year has been doing lately. So since mid-March, the 2-year has been going higher. And if the last quarter century's pattern manages to hold for another 25 months, then that would suggest that there's a better likelihood. And I guess that would stand to reason a little bit because we've had some inflationary pressures. Not that the Fed funds target rate is going to have any impact on oil supply, but oil supply constraints impact inflation, and it tends to permeate. So
I'm also, you're looking at the 2-year here, but I've become a little concerned with further out on the curve. Those rates have continued to go up. I'm looking at TNX. It closed north of 4.70 today. And that's maybe something to keep an eye on more, 10 to 30-year part of the range. And this isn't just limited here in the U.S. This is kind of globally back into the rates kind of across the board.
Gilts, it's obviously a problem. I mean, people are very concerned about about debt in the UK and what's going on there. This is the US 30-year, which is above 5 at this point. And if I just go back
peak for May is pretty interesting. It's what's being tested, I suppose.
Yeah, but if we just take a look, just so that people can get some perspective on this, because I think perspective is helpful. So what I'm going to do here is I'm just going to give you a sense of the last time we got back to this level. Now, the reason I show this chart, which is a pretty long chart, this is going back almost 50 years here now, was before the GFC. And I know that a lot of people have been sitting around, they're waiting for rates to come in, they're waiting for the Fed to cut. I think it's important to have some perspective on what normal rates actually are. I think a lot of people who've been market observers over the course of the last 10 to 15 years have a different perspective about what normal rates truly are. Before the GFC, the average 10-year Treasury rate in the United States was north of 5%. And since then, it's been 2.5%. Now, if you've only been in the business for the last 15 years, you think 2.5% 10s is a reasonable number. And if you started your career, as I did, about 20 years before the GFC, then you think 5% is normal. We both can't be right. There's a really, really big difference between 5% and 2.5% in the 10s. But I think I don't think rates are unhealthy here. They are unhealthy in some sense, though, and that is that there's a whole host of people who bought cars, bought houses, lived their life on the idea that credit was readily available and cheap. In fact, that it was sometimes cheaper than the real rate of inflation because we kept a lid on it. But I'm not sure that that's true. But the good news, to your point, I mean, you were just talking about earnings. You had mentioned that they were beating. And I think this speaks to, just so we don't sound too grim on all of this, it speaks to the resilience of the U.S. economy. You can see here, I should actually, instead of just putting current season, I'm just going to put all of the earnings since July 1st. How about that? And what you can see here are the earnings surprises since that time. And you can see that if it's mostly green, that means most beat on revenues. And if it's mostly green on this side, that means most beat on earnings. And this is exactly what you were talking about a few minutes ago. That's the case. And the second thing is growth, right? So, and you can see this broken down by sector over here. I mean, look at these sales growth numbers. I mean, that's pretty big, right? You know, the sales growth numbers are big. The earnings growth numbers, unsurprisingly, a little bit better. We've seen two factors basically go in. Wider margins will help improve earnings growth relative to sales growth, and also buybacks. You know, share buybacks will increase adjusted EPS, but the numbers have been generally pretty good. So I think, you know, on that score, we can be a little bit more sanguine, even though we are speaking about what could be a higher implied volatility. All right, let's see here. I think we had a couple questions, so maybe we can ask our crack production staff to bring that up. What do we got here? I'm gonna let you field the first question, Drew. Maybe we can tag team the questions. How's that sound?
Yeah, I like it. Okay, yeah, I can see this now.
Okay, so I'll read the question and you answer it. Hey, I love YieldMax funds and have done well with them, earning annualized returns ranging from roughly 20 to 170%. Hello there, chippy soxy buyer. You must some of your money must have been in that sector, I'm assuming. What do newer investors misunderstand most about YieldMax and the individual YieldMax funds it holds? How do you plan to market? Well, I guess this question is, I'm not sure this is a great question for you, Drew. How do you plan to market and explain these products so investors better understand how they work? Would love to see YieldMax thrive. Well, we appreciate that. But what do you think, from what you've seen and heard, what do you think is the biggest misunderstanding about things like YMax and also other YieldMax funds, in your view?
I mean, I think people need to understand what they're dealing with. I guess from a bird's eye view first, you've got to be positive on the underlying stock. If the underlying stock isn't doing well, obviously the fund, isn't going to go up. The idea would be that it would hedge away some of the loss of the underlying, but if the underlying is just going straight down, the fund isn't very attractive either. Basically, the idea here is that these are covered funds. They're partially hedged, as we talked about earlier, as opposed to a straight covered call where we would have a hard cap at some point to the upside. Because we're selling spreads, this can still participate in a good amount of the upside if there's a big upside move. On the other end of the spectrum here, the thought would be and the hope would be that if the stock did go down or the underlying stock went down, because we're selling call spreads against the underlying exposure, that would hedge away a piece of that loss. And so theoretically, this should do a bit better than the underlying on the way down. Yes, you would not participate dollar for dollar on the way up, but that's kind of a hedged instrument here when you're selling calls against an underlying. That's kind of what this is, and you have to kind of understand what the nature of the product is. I suppose that our internal guidelines, we're trying to basically hedge away 10% of loss. So, if this goes down $100, we would be down, say, the equivalent of 90 or 90% of that $100 move. On the upside, we're trying to basically realize at least 70% of the upside capture the underlying, so that if this does go up, you can still participate in the upside with the underlying. Is that somewhat clarifying?
I think it is. And now we're going to throw you on the spot and we're going to see how you did, because we're going to look at Coney and fiat and coin. And it looks like you did exactly what you just described. I actually wasn't pulling this up to see whether you were hitting the benchmarks that you had set for yourself. I actually was doing it just to remind people that of your first point. And the first point being, how do you feel about the underlying stock? If you like the stock, then that's the one you should own. And if you don't like it, well, in some cases, if we have a bearish tilting one, then you have that. So in this particular example, you said, to mitigate about 10% of the downside. And it looks like that's pretty much what you did here. Coney, which is the options income overlay strategy on coin, lost less than coin did. Obviously a very tough, period.
It's not been a good year for Coinbase, for crypto
No, it
in
certainly
general.
hasn't. But if you called that correctly ahead of time, then instead you would have actually owned fiat instead. And in fiat's case, the total return 57.4%, which is quite a good percentage actually of the downside move
better than the inverse of the underlying. So
yeah,
I didn't realize it had been that strong.
So that works out to 96.5% of the basically the inverse. Now I want to make a quick point about this. When we do these calculations by default in Bloomberg, people should know there's sort of an assumption that gets baked in about how that stuff gets reinvested. Not everybody reinvests. Sometimes you just take the cash distributions out. I know a lot of people do that and they'll allocate elsewhere. We would obviously want to be able to, compare it on both cases. So if you just simply took, put $100 in and took the cash, your total returns are a little better than 43% over the year. And I bring that up because, had you done it with Coney, and simply taken the cash out, it was a negative 40% return, which means that had you been, bought both. So if you had bought Coney and just taken the distributions, and bought fiat and just taken the distributions, you would have been both long and short the underlying between the two, and you would have effectively earned the risk-free rate of return on the difference. So well done there. I did that live. I hadn't actually taken a look at.
Well done. Yeah, that's good stuff.
Yeah. So all right, let's get the next question. Oh yeah, this is all about you here. My favorites are AMDY, Chippy Soxy, and INYY. That's new. They have the best dividends. Well, distributions. Let's start with that. How about we call them distributions instead of dividends? Because we do have funds that pay dividends, by the way. So for people who don't remember, Quad D actually does pay dividends and it does pay distributions together. So when you get a quarterly distribution from Quad D, a portion of that is a pass through of the dividends that the underlying constituent stocks have generated. And the reason that's important is because for some, there are tax benefits for qualified dividends. So depending on the type, who you are as an investor, where you are located, the type of account that it is held in, qualified dividends may be important to you. And the Dow Jones US 100 dividend index, if you own that basket of stocks, you still get a pass through. The dividend portion, at least, of that distribution will still be treated as a qualified dividend. The income that is generated from the options piece, I don't normally refer to that as a dividend myself, although I can understand why some people might. But that distribution is going to get treated a little bit different. But I guess, Drew, you probably can't play favorites. I mean, first of all, you're up and down some of these stocks. We just looked at one of those examples, Coney and Fiat. But inside of the YieldMax sort of family of funds, if I said to you, pick 3 as core holdings, and why, what do you think those might be? Just totally put you on the spot.
Think you
maybe you're going to pick something that you don't manage. I don't know.
Could put NVDY in there. It's one of the largest funds we have on NVIDIA. I told you earlier, the most interesting one, for better or worse, for me in the last few weeks is AMDY. And this thing, I was trying to remember, it didn't seem like it was that far. It was earlier this year, but I remember when I first started trading this fund, it was under $200. And I was selling like weekly premium for maybe $2, give or take. And now I'm selling for, I think it's asking for like $750 or somewhere thereabouts this week. Stock more than doubles. That in with the big jump in IV just generally week to week with this. And so, with a higher stock price, a higher percent volatility, we're selling for more and more here as this keeps going up and the IV stays elevated. And when they determine the distributions for this on a week-to-week basis, I won't get into the calculation. There's a few different things that go into this, but certainly what we've sold for, the premium, the that's one factor into the distribution. But the performance of the fund relative to the underlying is certainly taken into consideration as well. And with AMDY, as we were talking, because I've been selling relatively very, very tight spreads, as this thing has just basically gone nuclear for several weeks, I've been able to capture a very good amount of the upside on this. And so, selling for very juicy premiums, good underlying performance. So yeah, by and large, the distributions on this have been very, very strong. These are all, very similar, I guess. They're all correlated. Chippy, Soxy, I'm sure they both have some AMDY or some AMD and some Intel exposure in them. But, all these are that same chip trade, basically. They've all just gone to the moon.
Yeah, it is quite amazing. Let's see here. And it looks like AMDY has been getting, since the beginning of the second quarter, it looks like total return basis, you're capturing about 75% of the upside in AMD, which is tough to do. If you're selling upside call spreads in a stock that's up 165% in just over a quarter, that's something.
I guess back around, Mike, if I had just been selling, say, only single, like covered calls against that entire stretch when this thing, went up, that much. I mean, I don't want to wager a guess, but I would assume we would have captured more like 50% of the upside.
Oh yeah, I don't think you'd be in triple digits the way you are, up 124% total returns since March 31st. Just selling covered calls or selling puts, it would have taken a miracle, because you basically would have had to have just hit every tick spot on, sold puts just as the thing hit a high and let it go even higher. I mean, it's just, yeah, it would have been very, very tough.
Here's
Very,
a way
very
where
tough.
these can be, kind of tricky, because the product is a hedged instrument here. And so let's say that stock A dumps really bad today. Everything that I've sold, all the spreads that I've sold against it, they're immediately worthless. So I go in and buy them all back, but now I'm in the hole and I have no hedge left because all the theta has already decayed. I might have an inkling that, well, this might snap back. And, if I go ahead and start selling new spreads down in the hole, it's immediately going to whipsaw back in my face, and that might happen. But the danger is that, well, what if you're wrong and it doesn't snap back and it continues to dump? I no longer have a hedge in place here. And so now I'm basically losing dollar for dollar with the underlying, which is really not what the prospectus and what these products are meant to do. And hence, what I have to work with here, that's where I would sell very, very, very tight spreads, at least. In case this continues to drop, I'm going to continue to hedge away some of that loss. But if it does snap back, the benefit would be, well, the spread's very tight. The premium that I sold for relative to the width of the spread, risk reward, maybe it's 2 to 1 in this case, 2.5 to 1. If it does rip way back up, there's not a lot of notional at risk here. So that can still play very well to the upside. But if I had say, hey, I'm going to come in here and, I'm kind of naive. I haven't traded a lot of options in my life, for example, and I decide, well, I want to try to get as far away from this as possible, even though it's in the hole. Maybe I just sell a single leg, or, on AMD, I sell a 50 wide thinking, well, this is as far away from the current spot as I can get. And then the thing, goes up 100 points in 2 days. You're not going to catch much of that upside on the way back up. And that's the danger. And that's why I've sort of settled, maybe not great on my sanity, but at least from a fund performance, keeping these spreads with the notional at risk limited. From a longer term, perspective, I think I've been pleased with the performance. It's been more consistent.
Let me ask you this: how many trades do you think you do per week? I mean, rows of trades, like that.
Eric had sent out a sheet. They do more on the basket side because they've got several names in those basket funds that they have to just go through and trade on each one. Whereas, we have big concentrated positions, but 400 or 500 lines probably. And
100 lines a day. 100 lines a day.
This can vary too. I mean, in a case where it's early in the week and hey, everything it just came into the week and dumped. I might sort of piecemeal and instead of just doing it all in one fell swoop, I might do this in multiple tranches. So I might be sitting there throughout the day. Oh, hey, we got to push up here. I'm going to sell a little bit into this, and sort of work orders throughout the day. To kind of create almost like a manual sort of VWAP or TWAP kind of approach. There's other times, that it's late in the week, stock opens up way down. It's Friday. It looks ugly. I might just buy back a huge chunk, roll it all into next week in one fell swoop. And where the biggest trades from like a contract quantity standpoint is, we can't hold shares as the underlying exposure here. There's all these different ETF concentration rules for single stocks. And so we create share exposure, as Mike was saying earlier, delta exposure with combos, just, synthetic long stock position. We're selling puts, buying calls at the same strike. Each combo is 100 delta, or, the equivalent of 100 shares. But we do have to roll those. Options are forward priced. And when that comes up for expiration, if we weren't paying attention or we didn't roll the combo, suddenly that expires, and now we have no underlying share exposure, which is not good, obviously. And so we have to roll that out, when that comes due every time, and we'll do that in one fell swoop. So, I've had times in Palantir, a few months back, I think there were like 40,000 combos in there, and you would basically do a four-legged, roll of that combination or that synthetic stock position where if it's a long fund, I'm buying back, the short puts that I sold, I'm selling the calls in the expiring combo, and then doing the same thing, say a month out or 2 months out, where I'd sell new puts, buy new calls. But back when Palantir was like 40,000 combos, you're doing four legs at once for the whole fund. That's 160,000 contracts on a single trade.
It's a big trade.
Yep.
All right, what we got next here for questions? When I research, it seems like 90% or more of investments are ROC, or return of capital. Could you discuss why this is a good thing? Because it seems bad. Thanks. This from Derek. Okay, so let's just talk about what return of capital is, because there's two contexts. One is actual return of capital, meaning that you have money in a fund and money is withdrawn from the fund and paid back to the investor. Assuming there was no positions taken, no gains or losses, either realized or unrealized, that's a pretty straightforward issue. I have $100 in the fund. It's all in cash. I give you 50 back, $50 of return of capital. Now, in the context of ETFs, though, and these distributions, actually not just ETFs, but funds that are making distributions, there can be circumstances where you get something that is characterized as a return of capital as far as the IRS is concerned, but is still coming with positive total returns. Now, how and why does that happen? And why is it a good or a bad thing? So first of all, how does it happen? Well, if I make a distribution and I have realized losses and I have unrealized gains, by definition, I cannot pass through or pass back an unrealized anything. It is, by definition, unrealized. The position is still held. So if I have a very simple portfolio, and that simple portfolio just bought two stocks, that's all it ever did. It bought stock A and it bought stock B. And I buy these stocks at the beginning of the year, and at the end of the year, stock A is at this point up 50%, and stock B is down 20. Let's say these positions were equal weight. All right. So the entire fund has gained 25% of its value from stock A, because remember that was 50%. So 50% times 50% is 25% net gain. And the other one is 50% times -20 is -10. So at this point, I've got a 15% gain. And let's say I pass back, I sell my losing position at the end of the year. And from that, the proceeds of that losing position, I distribute 15%. The total returns of the fund for the year were 15%. But from the IRS's perspective, every bit of the 15% of the fund's net asset value that I return to you is considered return of capital. And that's because I realized the loss. So the money was coming from, the realized loss, the proceeds of that realized loss. That's the security I sold to generate the cash necessary to make the distribution. The gain, I still hold it. And if you hold the shares, you bought these shares, let's say they were $100 a share at the beginning. If you get a $15 distribution, now your basis is no longer 100. If it's characterized as return of capital, your basis in the shares has gone from $100 a share to $85 a share. And for most investors, this is a good way for this to be treated from a tax perspective, because most investors would prefer not to have an immediately taxable event. If things are going well, presumably most years you have net profits. Most years you have net income. And so if that's true, if anything, you probably don't want to have realized gains if you can avoid them. And so lowering your basis essentially doesn't eliminate taxes, but it can defer them, right? Because if I then advance the clock, so the shares went from 100 to 115, I passed 15 back, the shares are now 100, my basis is 85. Let's say they are unchanged for the following year and I sell my shares at 100. So I held them for 2 years, I have a basis of 85, and now I have a realized long-term gain of 85 of 15 bucks. And for most people that's a better tax treatment. Now if you had a lot of short-term losses, for example, within a given tax period, maybe you don't mind taking gains. But for the bulk of investors, it's better if taxable events are deferred. For most investors, it's better if a distribution of any amount, regardless of the total returns, all else equal, is characterized as a return of capital. So I think it's really important for people to understand that at the end of a tax period, we make estimates about what the return of capital might be for any given distribution, but that's something that can't be known until the end of the year when you can take a look at the entirety of the tax period, all of the realized gains and losses, and the sum total of the distributions, and then you can make that determination. But I think the simple way to think about it is, ignoring anything else, is it better if a distribution is characterized as a return of capital? For most investors, most of the time it is. So that's the first thing. The second is, what are my total returns? So, if your total returns are 15%, regardless of how much got distributed, whether it was 5, 10, 15, 50, you could have a 50% distribution and a 15% total return. But those are the things you should focus on. And then, something we don't talk about that often, but I would encourage people to think about too, and you will see this in AMDY versus AMD. You will see it in Coney versus Coin. I'm mentioning the names that Drew here trades. But those funds have lower volatility than the underlying stocks do. Those funds have lower peak to trough drawdowns than the underlying stocks do. And so think about the taxable implications. Generally speaking, for most investors, it's better if a investment pays you distributions on a regular basis, because you can always reinvest them, right? But cash in your hand gives you more flexibility than cash in an account. So, and take a look at the volatility of the underlying funds. So total returns, all else equal, return of capital is better. So that can be a good thing. Now there are limits. I mean, you can't just willy-nilly say, oh, we're just going to characterize this as return of capital. And you can't, as Drew just pointed out, when you roll the combos and do things like this, you have to effectively realize gains and losses. You don't have much of a choice about that. If a combo is expiring, you must adjust it. And actually, Drew, there's another circumstance too. You may need to adjust a combo if the stock moves by a huge amount, right? So if you have a stock like AMD that more than doubles in a short period of time, you had a combo that might have been trading right at the forward when you got started. Now it's deep in the money. What do you need to do?
So this is timely, actually. We're going to have to keep an eye on this for next week. Back to kind of all the rules here with ETFs, but there are concentration tests again. And what Mike's getting at is, if I say open a combo like on AMD at the close, let's say I just open it at the money at 540, it's pretty balanced. The call and the put, they're both at the money strikes. But if this were to say dramatically go up, for example, one side of this, or go down, I suppose, one side of that, the call or the put's going to inflate dramatically. And what can happen is that the value of the combo can get so rich that it basically triggers the threshold for the concentration test. And so what we would do basically in a case like that to, basically not trigger that breach is just box the combo rather than doing a jelly roll where think of a jelly roll as like a horizontal box. I'm taking the current combo, moving it out forward in time to the same strike would be a horizontal box. But if I stay within the same expiration here and just say, move that to at the money, it's just a box trade is all it is. I'd either be buying or selling a box basically to rebalance the combo at the money again, so that, let's say AMD goes up 100 points and I had sold, or, I had a combo at 540. That 540 strike call is going to be pretty deep in the money now if the stock's at 640. And so the value of that call is going to basically, go beyond the concentration threshold. But if I then take that and say sell a box to move that up to 640, well, now I've kind of rebalanced the call on the put side of the combo again, where one isn't dramatically in the money, if you will, and thus, very, very rich and breaching. It's 25% is what the actual threshold is.
Yeah. So, for those of you who may be familiar, you may have heard people refer to the 25-5-50 concentration rules for RICs. And basically what that's saying is that the number of underlying positions inside of a fund that exceeds 5% each must be below 50, and no one of them may be more than 25. And for the single stock options income ETFs, it's really that 25 rule that you're thinking about, isn't it? When you're doing this. And maybe you could just quickly explain to folks. I mean, I guess there's two ways to think about a box, right? So there's a box is a position in and of itself, but a box is also a trade. And in this case,
Yep.
The box trade that you're talking about is adjusting a position on one strike to a position on another strike in the same expiration. Whereas typically when I traded boxes,
all four legs are openers.
All four, yeah. So basically, I was basically, the way to think about it, an entire initiated box position, which is for those that are trading a lot of premium, probably going to be affected in something like SPX. That's basically like trading zero coupon bonds financed or financing inside of the options market. And it was typically to balance premium for those of us who were self-clearing, because there's really two things that affect your margin requirement as a self-clearing market participant in the options. And one is your risk. So there's a proprietary risk calculation that goes on at the OCC that establishes what the appropriate level of margin that a clearing member is subject to for the riskiness of a position. But the other is actually the net premium. So in other words, if I could have a very low risk position that spends a lot of premium, the seller of that premium is expecting to get their cash on settlement, which is T+1. So boxes are a very common way for options traders that have a lot of premium exposure to mitigate that. You can, if you're short a lot of premium, you can lend to the market. If you're long a lot of premium, you probably have to borrow from it. But could you just explain, because something like a jelly roll, which is basically trading one combo for another in time and possible strikes, versus a box, just tell people mechanically what you're doing there. So we already know that a synthetic equity position, the combo is a long call and a short put of the same strike and the same expiration. When you affect a box or a jelly roll, what are you doing mechanically?
Okay, so here I think this might be the cleanest way to explain this. Let's start with the regular box. This is a vertical box is how I would think about this. So let's say our current combo is on a $100 strike. Basically, I'm closing that combo, if that makes sense. I'm selling that synthetic to close, and then I'd be buying a new synthetic to open, say, at 110. What you're getting at, this was just an actual box trade where that was the actual strategy. Both sides would be openers. All four legs would be opening trades. What we're doing in this case is we're just closing one long synthetic, opening a new one on a different strike price. From a very high level to price this, all it is the difference in the carrying costs on the two strikes. That's all that's going on behind the scenes here. They're both, I'm going short one combo, that's the closing trade. I'm going long another combo, that's the opening trade. So it's still a box. It's just, we're not creating a brand new four-legged box position. It's the same action. I guess that's the only difference is the action, closing versus opening. To kind of extrapolate that, if I was going to say move this same combo rather than to a different strike for the same expiration to the same strike on a different expiration, that would be called a jelly roll. kind of an interesting term. I honestly don't know where it came from. But think of that as a horizontal box. In my case, I'm closing the box on the near-term expiration, and I'm again opening one, same strike, but on a different expiration. And again, to price this, it's just a function of the difference in the carrying cost between the two strikes. Obviously, in this case, one of these is on a different expiration. To kind of bring it, I guess, full circle, a lot of times, as we've been talking, these stocks move around quite a bit. And if I'm doing a jelly roll, it might be at a very different price point from when I put the previous combination on. And so I would kind of think of this as like a diagonal box. I don't know if you ever heard of Natenberg. He wrote it's kind of viewed as the I guess, calculus-based options
Sheldon
Bible.
Shelley
Yep.
Natenberg wrote, it's called Options Volatility and Pricing. And I actually, one time when I was, this book right here, but have ever heard of it? That's it.
I always told people, I said, that's probably the Bible.
This one's mine.
I said, if you want to really know how to trade options, Natenberg's sort of the non-calculus Bible. And if you want like an actual like advanced math Bible, it's Options, Futures, and Other Derivatives by Hull. The appendix in that is very, very mathy, but they're both incredibly good books if you really want to go like full math on options pricing. But Natenberg has a little section that he actually touched on this, and I built a pricing, like just a basic algebraic pricing formula by sort of reading between the lines of his book, actually. And interestingly, it's usually within like 1 or 2 basis points of my real like academic, real like advanced math pricing formula. But just interesting, there's a lot of ways to kind of skin a cat. But he calls it a time box, is what he calls a jelly roll to a different strike. And all it is really a combination of a vertical and a horizontal box. That's actually what it is. But what we would be doing is say, I'm on a 100 strike combo for, say, this week, and I'm going to roll to AUG. So I'd basically be closing, the 100 strike combo for this week, rolling to, say, a 110 for August. So it's a different expiration and a different strike. And basically, if we break this down component-wise to what's actually happening, what I'm doing is, step one, I'm doing a vertical box for this week, for the remainder of time to the front month expiration. So I'm basically doing a box from 100 to 110. That's component one. And then I'm doing an actual horizontal or a straight jelly roll from 110 to 110 from this month to August. That's what an actual diagonal box is. It's just a combination of the two. But all three of these, all they are is basically carrying cost plays. If you were to do, like Mike said, all 4 legs as an opener, it's just a difference between the carrying cost on the strikes is what we're looking at here.
So, I think we'll probably wrap it up with the following concept, but I'm going to give people, everybody who's watching, a little bit of a quick lesson on this and a back of the napkin way to think about some of these things that will give you maybe a little bit of intuition about why people are even talking about things like carry cost. So let's just talk quickly about what that combo is, because we trade a lot of them. So you're long a call and short a put of the same expiration and strike. So simple example, I have a $100 stock. I buy the 100 strike call and I short the 100 strike put. And we're going to ignore if it goes exactly to 100 at expiration. And let's assume that that position expires in 90 days. And let's further assume that I paid, for simplicity, we'll say that I paid $5 for the long call, and I sold the short put also at $5. All right. Now, I laid out no net premium because I spent $5, collected $5. If the stock is above 100 at expiration, I own the stock at 100 because I'm long the call and the call is exercised. If the stock is below 100 at expiration, I own the stock at 100 because I'm short the put and the put is assigned. So either way, I'm long the stock at 100 forward as of the expiration date in this example. Now, the reason there has to be a carry cost associated with this is that if there was not, because I had no net premium outlay in this example, I would have equity exposure, but I didn't actually put up the cash, which if I had bought 100 shares of the stock, I would have $10,000, let's say. And there is a risk-free rate of interest. Let's say that the secured overnight financing rate, SOFR as we call it now, LIBOR, which is what we used to use, is a risk-free rate of interest that you could collect on your cash balance. If there was not a cost of carry embedded in the cost of the combo, what would happen is there would be an arbitrage, because you could simply buy the combo and keep the cash. So your combo is secured by the cash, but you're collecting the interest. Whereas if you bought the stock, you have to put up the cash. And you have to put up the cash whether you actually have the cash in your account or not, because if you buy stock on margin, you're borrowing money. So the cost of carry is always there. So the higher interest rates are, all else equal, the higher the forward. And if a stock pays dividends between now and expiration, then you have to back that back out. You take the net present value of the dividends out. So the math is this. It's the risk-free rate of interest times the strike times the number of days to expiration. And in finance, they typically use 360, but just call it 365 for the number of days in the year. And that is an approximation, non-compounded, of the costs of capital, right, between now and then. So the higher the strike, the higher the forward, all else equal. The higher the cost to carry, all else equal. And then, of course, you take whatever the dividends are, and then you would have to subtract it. But most stocks, especially these high volatility ones, don't really pay dividends these days, so it's not as applicable. But
and that interest rate, that's where I'm always being sort of cognizant when we do these trades. A box or a jelly roll, I'm solving basically for an implied rate. So, for example, if I'm rolling, let's say a diagonal box, I'm going to roll an expiring jelly roll that's 100 strike up and out to a 110, say for next month. I'm selling the box first, say, or at least component one. I'm selling a 100, 110 box. So maybe I would sell that in a vacuum for 950. I'm buying the jelly roll because I'm buying a new combo that's further out than the one I'm selling, and so obviously it's going to have more time on it. I'm going to have to pay for the difference in time, the carry cost again, and so maybe that's, let's just say, 50 cents. I've sold this 10-point box for $9.50. I'm paying another 50 cents for the jelly roll. So basically, my proceeds in this trade would be $9 to move this up 10. I'm going to take that number and actually the haircut, and then I'm going to go into a little math formula, and I'm going to solve for the actual interest rate based on the quote they give me and the strikes that we're working with and the time to expiration. And I'm going to basically see, hey, is this a reasonable interest rate? Because on occasion, the prime broker will come back and, they go out to all the dealers and banks and solicit interest, try to find the best rate. But once in a while, it's not pretty. I had one a few weeks back, and Goldman had come back with like a 6.4% implied rate or something like that. And I just was basically like, is this a joke? And so I counter with a different quote, and we end up getting a more reasonable interest rate. But if you're not careful, you're basically, the way to think about this is you're borrowing more than you really should be to hold that exposure, on that combo, that underlying exposure. And we don't want to just give, a free lunch to the dealer or the market maker on the other side. So I'm always running numbers anytime I do this, just to make sure that the quote, is rational and they're not eating my lunch.
You are earning your keep. You are earning YieldMax fees, which I think one of the reasons I'm glad it's a little bit of a rabbit hole, I realize, and it's not critical for investors to understand all of this intimately, but I think it serves them well to at least have a passing understanding of some of these concepts, because there is more to running strategies like this, both in terms of the trading activity, which you already alluded to, 400 or 500 lines in a week. I mean, that's just incredible. That's a trade every 4 minutes. If they were all evenly timed, which you probably sometimes wish they were,
Mike, the
That would
real
be about a
trick
trade
is,
every 4 minutes.
well, you trade too. I mean, you can probably echo me, but getting the trades off in Bloomberg's order entry system is not efficient.
It's yeah, it's interesting. I mean, look, I started my career on the floors, open outcry, paper tickets, colorful jackets, yelling and screaming. On the NYMEX, once you carded 4 trades, you would take the hard ply and you'd throw the hard ply into the air, and an exchange official would actually catch it and book the trade. So when I look at the way we do RFQs and things like that in Bloomberg now, it's a little better than the Stone Ages. I'll say that much. I think that's kind of an important one. Well, Drew, this has been highly educational. I hope those of you who tuned in also found it interesting and educational, and gives you a better understanding for what these funds are actually doing and what the traders are doing each day. Trying to effectively manage your money in the options markets. So if any of you have any additional comments or questions, suggestions for future shows, whatever it is, please be sure to send us a post. At YieldMax ETFs is our X handle. As always, this particular video is not evergreen for reasons of compliance. People like Drew and myself can have off-the-cuff conversations, but they can't stay up forever. It can't go into a book. By the way, if you want a book on options that is not quite as mathy as Hull and is a little bit more mathy than Natenberg. Actually, you know who else is really mathy? Did you ever read Black-Scholes and Beyond? Neil Chris?
No, I haven't read the book, but
yeah, that's a good one.
I'm kind of OCD, as you can tell, so I like to dive into the math side of this stuff a lot.
All right. Well, so I'm a little bit more mathy than Natenberg. The Options Edge, Wiley, published in 2016. People can read that if they like. If you really get wonky on this stuff, you can read Alexander, which is basically 340 pages of derivatives formulas. And we will find out just how Rain Man you are if you do, because I had a colleague who read that book because I used to use it as a reference text. I think I might have it over here. So whenever I needed a formula and I didn't memorize it, because I don't memorize all the formulas. And if there's an error in one of the formulas here, I encourage you to go find it. And I never published a second edition, so I never got to correct it. But somebody did catch it. Somebody looked at every formula, coded every single formula in the book, and then sent me an email and said, hey, I can't get this formula that you wrote to work. And then I looked at it and I was like, this seems right. Oh, there's a sign wrong. I will give $100 to the first person who comes back and tells me what page and formula that is. That'll be evidence that you read the book. Win a prize. Do that. So until next week at this time, Drew, thank you so much for joining me. Really appreciate your time and wisdom. It's been enlightening and fun. And to all of you who tuned in for this, thank you guys, as always. And we hope to see you here for the next Go Down next Thursday.